Whenever a party buys or sells a business, it can be a very complex transaction that deals with a lot of different issues. Of course, tax is going to be one of those issues. Now, even though the tax consequences of buying or selling a business are very complex, it's actually one of the most interesting areas in all of tax because you get to see how different parties interact with one another and how they have different preferences. Now, there's inherent tensions between the objectives of the buyer and the seller with respect to the purchase or sale of a business. That's why every business negotiation is unique. It turns on the respective tolerances and appetites of each party based on the party's particular tax and financial circumstances. Now, this discussion will only talk about the tax considerations, but just keep in mind that there will be other financial considerations. So before we discuss the specific transactions with respect to a sole proprietorship, which is what I'm going to deal with here because many of the concepts that apply to sole proprietorships apply to businesses across the board, I want to talk about just some general ideas of the goals of parties involved as well as ways of various issues that parties may have with respect to a purchase or sale of business. So the seller is going to have a gain or loss on the sale of a business. You can view the business as a combination of multiple assets, liabilities, and whatnot. It's not simply just one asset and a purchase price. Okay, you take the amount realized minus the adjusted basis of that asset and you have your realized gain or loss. There's many assets in a business. It's a box of many different assets in the company. Some of those assets are tangible, some are intangible, some are hard to value, such as goodwill. It's a combination of all different types of issues. Now, with respect to the seller's gain or loss on transaction, because we will have a sale here, we're dealing with a sale. And if you recall from previous tax discussions, when there's a sale or other disposition, we are going to have a realized gain or realized loss. When the seller sells, the seller is going to prefer to have preferential rates when it comes to gains. Preferential rates being long-term capital gain, 1231, those types of items that create a preference with respect to a lower tax rate than the ordinary income tax rates. If a seller has a realized and recognized loss, then the seller prefers ordinary because, as you may recall, there's all sorts of limitations with respect to capital losses, and ordinary losses allow more benefit to the seller. Now, in this discussion, we're going to assume that gains are going to occur. Now, if you have losses, you kind of do the opposite, a flip of that, if you will. But we're going to assume for this discussion that the seller has gains with respect to all the property. Maybe the seller purchased this, build up this business over 50, 60 years over the life of the seller and started it from pretty much nothing, and all there has been is gains. It's going to be nothing but gains. All the assets have been depreciated or amortized, or and there was nothing really put into it, and now this business is a very large business. So this discussion is going to assume that we have gains in the transaction. So the seller is going to want to get preferential rates. The buyer, on the other hand, has a different goal with respect to time value of money. Our good friend, time value of money, how that becomes a huge issue in tax timing. Simply, the buyer wants to depreciate, amortize, and get cost recovery deductions as soon as possible. As early as possible. And as much as possible up front. Because recall that $1 today is worth more than $1 tomorrow, or in a year, or 2 years. The idea is that if you have that dollar, there's a time value associated with that money. You can take that money, you can invest it, you can do with it as you please. That if you get the same dollar in a year from now, you don't have that ability. So the buyer wants to be able to get those deductions as soon as possible. Because remember, the basis concept is integral to assets, and it is inherent in that recovery of or unrecovered capital. So the recovery of that unrecovered capital over time, and if we can get that sooner rather than later, that is a benefit to the buyer. Now, before we actually go through how we allocate the purchase price and sales price of a business using the residual method, I just want to talk about some general considerations. So one thing I want to mention is that it's important to consider, with respect to this purchase and sale of business, whether the payment will be now versus later. So I'm talking really about installment arrangement. And a lot of purchase and sales, it's not simply just a lot of money all up front. It might be $10 million today, $10 million a year from now, and more money in the future based on maybe some expectation of profits that will be earned. We'd call that an earnout provision. That would be an installment arrangement. Now, my discussion, I'm going to assume that the seller and buyer, it's all just going to be a cash up front, no future payments, so all money today, payment now. So, and it's going to be all money, so a lump sum up front. There's other issues with respect to buying and selling a business that deal with business entities. What kind of entity you have. We're going to assume it's a sole proprietorship, and the reason that is because with respect to the rules that apply to sole proprietorships, they also apply in general to corporations, partnerships, limited liability companies, all those different types of business entities. So these are the general principles. And if you understand this, it'll be really easy to understand many of the other business entity issues with respect to purchasing and selling a business. There's just a few other things. For example, corporations don't get the preferential rates, those kind of things. So you just have to add a few more layers to it, if you will. One thing I want to mention about the business entity is that with respect to corporations, there's some more planning issues with respect and questions with respect to an actual purchase and sale of business. These include, it's possible with the corporation, C or S corporation, to have a tax-free purchase or sale through a reorganization. We're not going to go into that because, again, we're assuming sole proprietorship. Another thing is an asset versus stock sale if you're dealing with a corporation. The idea is that with an asset versus stock sale, selling stock is generally viewed as a capital asset for most taxpayers out there, with some limited exceptions to dealers and brokers. An asset sale, though, creates different tax consequences to the seller. Same with the buyer. If the buyer's buying stock, that creates, well, you can't depreciate or amortize stock. You just have to wait until you sell it or exchange it in the future. So that creates all sorts of issues. And again, in this one, we're dealing with the sole of a proprietorship, which you're going to see is going to be a sale of assets and purchase of assets. But just keep that in mind that when you're dealing with a corporation, there's a few other additional issues, such as reorganization versus non-reorganization. So reorganization creates a tax-free exchange, and if you don't have a reorganization, it's going to be taxable exchange, but there's an issue in terms of not getting your cash. If you're a seller, you want to get as much cash as you can. That's usually what it is, and you want to get that as soon as possible because of time value of money. When you have a reorganization, it's not going to be all cash. It's going to be a portion in stock. And then the asset versus stock sale, as I mentioned. So I want to remind you again, keep in mind always the seller's goals versus the buyer's goals. There was a case back in the early 1900s known as Williams v. McGowan. Williams v. McGowan. And this is before the rules were in the Internal Revenue Code. There wasn't even an Internal Revenue Code at the time. It was a bunch of different tax laws. Our first Internal Revenue Code was in 1939, and the Williams v. McGowan decision was in the 1920s. This is a circuit court case, but it was the most relied upon circuit court case with respect to buying and selling a business up until we have Code Section 1060, which provides for the approach that we're going to do in this video. So that Williams v. McGowan decision really has been codified through Section 1060, and Section 1060 basically says through regs and the corporate regs, we use what's called the residual method to allocate both the amount realized for the seller, so the sales price, if you will. So this is going to determine our amount realized for each asset and the basis, the cost basis that the buyer takes. So that's what this residual method is going to do. It's going to determine the amount realized for the seller with respect to each asset and cost basis for the buyer with respect to each asset. So it's the same approach. Again, though, there's a tension, and that's what's so interesting because the seller might want to value certain assets higher and the buyer might want to value certain assets lower because of, again, the different goals. Now, there might be some overlap, and that's what's interesting. If you've ever done a mock negotiation or a real negotiation before, there's always some win-win situations. There's going to be win-win situations with respect to the buyer and seller in buying and selling a business. However, there's going to be situations where one wins, one loses, and what can maybe bring the parties together is the amount of the purchase or sales price. That's one thing that we always should keep in the back of our minds is, yes, there's ways to maximize after-tax return for the buyer. There's ways to maximize after-tax return for the seller. But the purchase price, the dollars in the end that are being paid as part of this lump sum agreement, that could remedy one party over the other for getting the benefits. Now, when you think of a negotiation, you usually think about two parties involved. You have the one side and the other side. Here, the buyer versus the seller. And generally speaking, you'd be correct. That is true with respect to purchasing and selling a business. However, a party that many people forget about, or parties, deal with taxes. So the government's share of these transactions. There's ways that we can structure the transaction so that the silent party, if you will, the government, whether it's the federal or state government, we'll say federal in this case, we're going to deal with federal tax issues in this video, is actually cut out of the transaction. Now, we usually do this through parallel payments, which means that it's neutral with respect to the government, meaning that the buyer gets a benefit and the seller gets an inverse benefit. So seller might have to pay, tax on something and buyer gets a benefit for that same amount. So it basically gives the government zero. And we're not going to go too much into parallel payments, but that's a topic for another discussion. So now I want to go into the residual method. The residual method, again, is how we're going to determine the amount realized for the seller and the cost basis for the buyer with respect to each asset. The residual method says we're going to respect what the buyer and seller agree with respect to the value. Whatever the buyer and seller agree with respect to the value of each of these assets, we will, or the IRS, I should say, not we, the IRS will respect that. And this goes back to the whole premise of fair market value in the Internal Revenue Code, which is actually found in the estate and gift tax regulations. Now, there's going to be some bounds. You can't go too far out of the bounds. I mean, the IRS will recharacterize a transaction. But if the business is valued at $1 million by many appraisers and the buyer is willing to pay $1,200,000 because there's a lot of different parties involved and they just want to get it, that's the fair market value of what the parties agree. The issue becomes, how exactly do we allocate that purchase price for amount realized purposes for the seller and basis purposes for the buyer among the different assets? And there's 7 classes. The 7 classes are based upon liquidity. So the residual method is all about liquidity. How liquid are each of these assets? And the more liquid an asset is, that's the order that we go down. So what we're saying is, if you have $1 million purchase price, and the value is agreed on certain assets, you go in order by each asset until the purchase price amount is fulfilled. We go in the order starting with cash, which is class 1, and then we go down until we fill the values. So it's possible that the last class, which is class 7, goodwill and going concern, might not get it likely won't get the value because, again, there's not enough of the purchase price to fill all the fair market values. So the order, again, is based upon liquidity. So the first item is cash. And I'm going to go through the seller and the seller's order or preference with respect to these items. But first I want to talk about each of these items just in general. So the first one's cash and bank account amounts and CODs through bank accounts. The next category is actively traded personal property, which generally is thought of as publicly traded stock and government securities. There can be other ways, other items, but we're really talking about financial securities here that are actively traded on active markets, like the New York Stock Exchange or the NASDAQ, or even Worldwide Stock Exchange. The third class are other mark-to-market securities. So the ones that aren't captured in class 2, the other mark-to-market securities, these are generally thought of as like closely held securities. So some private corporations that aren't on the markets, these are going to be mark-to-market securities or small closely held businesses. Also in category or class 3, I'm saying category, but you can use them interchangeably. The code says class, but I've heard many people say category. Class 3, accounts and notes receivable. Class 4 is inventory. Class 5, this one's interesting. I know the code, they love, the tax law loves to do this. All assets other than classes 1 through 4 and classes 6 and 7. So I'm going to come back to this one, but class 6 is intangibles other than class 7, and class 7 is goodwill and going concern value. So class 6 includes all other intangibles other than goodwill and going concern. And the reason, if you think about liquidity, goodwill and going concern, goodwill is the value that a business, if you take its assets minus its liabilities, the assets that can be actually ascertained. That's going to be that going concern, or that goodwill or going concern value. It's part of that. It's hard to quantify. The intangibles, other than goodwill and going concern, those are hard to value. A lot of intangibles are based upon cash flow valuations and whatnot. Now, all the other assets, other than classes 1 through 4 and class 6 and 7, that's everything else. Now, some of the major ones when it comes to a business include land, depreciable personal property, and buildings. And there's others out there. You could have artwork, right? Artwork that's not depreciable. It's, it might actually appreciate in value, but that's, I'm not going to talk about that. We're talking about the major types that fall in this class 5. Now, before we go into the seller versus the buyer and the order of preference, I want to mention that with respect to some of these assets, there's not really going to be too much valuation concern. However, other assets there will be, and it could be very, very different in terms of the range. Different valuators, different valuation experts might give assets a high range or a low range when you look at the different valuation experts. But I will tell you that with respect to most assets, you're not going to get the same exact number when you go from one valuation expert to another, especially when you start getting to the lower classes. So cash and bank account amounts, there's usually no valuation concerns there. That's going to be the adjusted basis, the face amount, the fair market value is usually the same. Actively traded personal property, so that's publicly traded stock, government securities, usually no issue there with the terms in terms of value, but potentially could be. So other mark-to-market securities, now you're getting to where you can have valuation issues because you're talking about closely held securities, which there's no market for, so it's hard to value. Accounts and notes receivable, this deals with, okay, one valuation expert might say, okay, well, I don't think that the business would have collected a certain portion. Another one says, oh, well, I think it's a smaller portion they would have collected. So it creates a range there. Inventory, again, valuation differences there. When you start getting down here, class 5, 6, and 7, you start getting a very wide range in terms of valuation. Land, we all know about real property with the buildings and the land on it. When you talk about realtors, you have listings for houses, business property. You come in at different offers and whatnot. Different experts, different valuation experts will be all over the board when it comes to this. Depreciable personal property, same thing. Intangible assets create even more range because, again, it's usually valued on cash flow and other types of models because there's no actual personal item that you can value, and it's kind of hard to do comparables. And then finally, goodwill and going concern. This is going to be one of the hardest because usually it's thought of as, okay, it's the residual amount after you take into account all the other assets in the business after the liabilities and that value of the business. So that's a function. That's like an indeterminate amount because it can change depending on everything else. I mean, we still have to figure out a value though. So this one will usually have the highest range, goodwill and going concern. All right, so I first want to go through the seller and the order of preference with respect to each of these items. Now, class 1, again, won't have any difference. So with respect to the seller and buyer, we're not going to talk about that. Class 2 and class 3, the other market-to-market securities. So these are dealing with like financial securities. Now, if the seller holds these for more than a year, it's going to most likely be long-term capital gain because we're going to assume that the seller, and just like in almost every case, is not going to be a dealer or trader in securities, and therefore it will be a capital asset. So the seller would have long-term capital gain if held for more than a year, which the seller wants to maximize preferential rates like long-term capital gain and 1231. However, if it's held for a year or less, it'll be short-term capital gain, which results in ordinary income, so the seller wants to minimize that. Now, accounts receivable, which is class 3, that's going to create ordinary income. So the seller wants to minimize any ordinary income because, again, no preferential rates. Inventory, same thing. Inventory creates ordinary income rates, so the seller wants to minimize that. Now we get down to class 5, things start getting very interesting. Land, and we're going to assume that all property with respect to our business is business property. If you have investment property, that's going to create some issues. But let's say we have business property. Now we have sales. So remember, sale or exchange creates that capital or 1231 item. So let's say we have land. Now if land is held for more than a year and it's business land, then it's going to be 1231. We want to maximize 1231 because, again, it's preferential. Actually, 1231 is more like nirvana. If you remember 1231, you do the netting. If you have a positive 1231, everything's considered capital. But if you have negative, it's actually ordinary. So 1231 is a really good situation. So 1231 actually would be better than anything that's considered long-term capital gain, because if it's a loss item, which again, we're assuming for our discussion that everything will be a gain here, losses have a different analysis. We'll call that more discussion because there's obviously limitations on losses. But with respect to losses, it'd be ordinary for 1231 purposes if everything nets out to a negative. So land, if held for more than a year, would be 1231. If it's held for a year or less, it would be treated as ordinary, and we want to obviously value that less. But let's assume the land here is 1231, so we want to value that high. If we have depreciable personal property that's not 1231, so it's not held for more than a year, then we want to value that as low as possible, because the idea is that the ordinary income property, that's going to create a higher rate, and this was held for a year or less, so you can't get that preferential. Depreciable personal property that is 1231 is interesting because we have to worry about the ordinary depreciation recapture, and the rest will be 1231. Now this one's interesting. The ordinary portion, normally we think of as we want to decrease this, right? We want to devalue this. But look at this. Whatever is beyond that ordinary recapture amount is going to be considered 1231. If you have forgot about recapture, the way it works is the amount of recapture, generally speaking, is usually the lesser of the realized gain on the transaction or the amount of depreciation. So think about a situation where we have an asset that the company's selling for $100,000, and the depreciation, and let's say the basis is $20,000, so that's an $80,000 gain, but the depreciation was only $20,000. So the first $20,000 of that $80,000 gain will be ordinary recapture. The remaining $60,000 of that $80,000 gain will be 1231. So actually, when you look at other items with respect to the ordinary, you would prefer to actually maximize this because you get at this. So we actually want to get at the 1231. So we want to value these items as high as possible. So we actually value the depreciable property, generally speaking, that's subject to depreciation if it has that 1231 potential. So it really depends on how much depreciation was taken and how much the gain is. But generally speaking, we want to actually value that higher because when you compare it to the ordinary and the short-term capital gain items, it's way better benefit. The buildings generally create 1231. So just like the land, we want to value that as high as possible. Intangibles create all sorts of issues. Intangibles, it really depends on how you're classifying the intangible with respect to selling it. It could be potentially it could create a 1231 in a recapture situation like the depreciable personal property, but it's also possible that it doesn't create that, maybe just capital gain or whatnot. It's also possible that it's ordinary. For example, copyrights. Copyrights that are self-created are treated as ordinary income. If it's ordinary income copyright that's self-created, you want to go as low as possible on that. But if it's, again, 1231 recapture, which is a lot of the intangibles that have been amortized, you want to value as high as possible. There's some special rules with regard to patents and certain types of intangible property. Self-created patents, formulas, secrets, inventions, under the Tax Cuts and Jobs Act, if they're self-created, the law changed to make it similar to copyrights, where it is treated as not a capital asset, so it could potentially be treated as ordinary, The problem, though, is that Section 1235 is out there, so it is possible that patents could also be held the same like copyrights and receive ordinary treatment. Now, historically, patents have received the most favorable treatment with respect to intangible property, so just keep that in mind. Very important. That it's beyond the scope of going into this, but just understand that certain self-created intangibles can actually create ordinary income, but most are 1231 type. So be careful with this. It really depends on it, but generally speaking, the intangibles will be 1231 and recapture like the depreciable personal property. So we want to value those as high, and then with the exception of the copyrights that are self-created. And again, starting in 2018, patents, formulas, trade secrets, and inventions that are self-created also could potentially have ordinary treatment, just like those copyrights. That's going to be ordinary income and it will result in ordinary. So we actually want to value that as low as possible with respect to the seller. Now, finally, goodwill and going concern. This is another one that really depends. A lot of times, goodwill is long-term capital gain, but it's also possible it could be 1231 recapture if you purchased the goodwill previously. And in both of those situations, we want to value high. Now, here comes the order of preference. So we want to value as high as possible the items that give 1231, pure 1231. So that would be land. So we're going to categorize this as a number 1 on the scale. So this is a number 1. Also the buildings. Next is going to be anything that's long-term capital gain. So here, if we have these securities that were held for more than a year, then we want the long-term capital gain. Third, so that was second. Third will be anything that creates ordinary income first and then 1231, because again, you can get that ordinary income first and then everything after that is going to be considered 1231. So everything beyond that is 1231. So we'll do those third, because it's like a mix. It's like portion recap, ordinary, portion 1231. And it's possible that you don't have any 1231, so you got to be careful there. But you definitely are going to have ordinary income recapture if there's a gain. So that would be these down here. Okay. Sorry, I missed the goodwill. The goodwill down here, long-term capital gain, that would be 2. And then finally, number 4 would be anything that's short-term capital gain or ordinary. So pretty much everything else. So that's 4. So there's really an order of preference of 4. 4. Again, first, we want the pure 1231 items. Because again, that's nirvana if you have gains or losses. Second, you want long-term capital gains. Third, you want items that have recapture involved, such as the depreciable personal property or the intangibles that have amortization. And then finally, fourth, any ordinary income or short-term capital gains. All right, so finally, let's talk about the buyer. Let's talk about the buyer. So the buyer wants to, again, time value of money, wants to depreciate and amortize as soon as possible or take cost recovery. So when we go through these items, the securities, so these are class 2 and class 3 securities. Securities have no cost recovery until you sell or exchange. And if we are going to hold on to these assets as a buyer for a very long time, we plan on holding these securities, then, which is what we're going to assume, we're going to take a conservative approach here. That means actually that we're not going to get the cost benefit recovery until we sell it, which could be 30, 40, 50 years out. Maybe even never, because maybe we give the property to our children through a trust or through a will. So this one's actually valued very low, very low. All right, next, accounts and notes receivable. So with accounts and notes receivable, the idea is that if we value these high as a buyer, when we collect on them, we don't report as much income. So this is actually an income deferral measure. So we actually want to value this as high as possible because we don't want to have to report income, because the idea is that under a general or a reasonable assumption in accounting, we're going to collect these accounts receivable within the next year. Now, obviously, we're not going to collect all of them, but what if we do? Then we want to value this as high as possible because we're going to be collecting this. It's basically the possibility of deferring income for as little time as possible, a year or less, if you will. Inventory is the same idea, but inventory creates a deduction through cost of goods sold. It's a cost of goods sold deduction when we sell it, and the idea is that, and again, under a reasonable assumption, we assume that we're going to collect or we're going to sell our inventory as soon as possible within a year. So we're going to value this high, very high. All right, so now we start getting to class 5 and class 6 and class 7. So land has no cost recovery. It's very similar to securities. You can't depreciate, amortize, or do any other types of cost recovery with respect to getting a benefit in the current term or soon, not until you sell the actual land or exchange it. So we want to value this low. The depreciable personal property, whether it's 1230, well, for the buyer, it depends on how long it's held, whether it's 1231 or not. But any depreciable personal property is 5 or 7 year depreciation. This is fast depreciation. It's also makers, which is usually double declining balance. Double declining balance. We want to value this as high as possible because you're going to see it's going to be a lot quicker to depreciate and than others. Further, bonus depreciation, 100% immediate depreciation from bonus depreciation, or some accelerated depreciation under bonus depreciation, or Section 179 with respect to this type of property. That's usually where it applies. That can also apply. But if it doesn't apply, you can at least get 5 to 7 year property depreciation, which is better than the other types of things we're talking about here. Buildings are over 27.5 and 39 years, 27.5 for residential, 39 for non-residential. This is a really long time. We want to value these as low as possible in comparison to the other types. And finally, the intangibles, 15-year amortization straight line. This is over a long time. Now, if you compare, 27.5 and no types, that's obviously, no recovery. It's better to have 15 years. So I would say this is actually kind of neutral. It's like in the middle. If you can value it high, but if you have other things, value it low, like a lot of depreciable personal property. But a lot of companies today have intangibles, so it really depends. So we're going to call this one neutral, a neutral one, like it's kind of in the middle, if you will. And that's intangibles and goodwill going concern, because when you buy it under Section 197, they're all treated the same as 15-year property. All right, so finally, now we want to do the order of preference for the buyer, and I have five order of preference for the buyers. So the first thing we want to maximize, order number 1, would be the things that we feel like are going to be recovered within the year. So that's going to be accounts receivable and inventory. So those are given a 1. Those are given a 1 on the list, a 1. So those are the first things the buyer wants to maximize in terms of the value with respect to allocating under the residual method, if you value higher, right, versus lower, the other things. Because again, it's all about how are you valuing these things, because you only have a certain amount with respect to, it goes down the line, the waterfall, if you will, of these classes. Okay, so the second thing is going to be the personal property, because that's 5 or 7 year. Because again, we're looking at the cost recovery period. Next is going to be the 15-year intangibles. So we're going to do 15-year intangibles are number 3. The fourth item is going to be the buildings, because they do give us some depreciation, even though it's not very good. So that's going to be a 4. And then finally, the 5th are the things that generally don't give us any cost recovery until we sell it. So that's going to be securities and the land. So we're starting to see this tension already. For example, look at the accounts receivable and inventory. The seller wants that last, but the buyer wants that first. That's going to create some tension, because the buyer's going to say, oh, I want to value that as high as possible and the highest end we can, based on what the valuation experts have done. However, the seller says, no, I want to do as low as possible, because that's giving me all ordinary income. So you see that tension? So why don't you go ahead and take a look at this order classification for yourself and get an idea. The next best way to consider how this works is actually see an example, which I'm going to go through an example in a later discussion. So I hope that this guide helps you in terms of understanding how buying and selling works. Again, the idea is that you're allocating the purchase price, a basket purchase price of the amount realized for each asset for the seller and the cost basis for the buyer. And we're doing that using the 7 classes under the residual method. And again, the seller, it depends on the characterization. The buyer, it depends on the cost recovery with respect to the goals, the overall goals. And again, there's an ordering, a 4-step ordering for the seller, a 5-step ordering for the buyer. So I hope this really helps you, and I think it will.